Welcome to Investor's Guide, and thank you for tuning in. On the next half hour, we're going to help you figure out how to manage your money better so you become a more confident person when it comes to your money. Let's start by taking a look at our conservative portfolio. We'll also look at the Reliance Equity Opportunities Fund and tell you if you should continue investing. And we'll help you understand how to buy mutual funds online. All right, let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show. Now, we talked about this over the last couple of weeks as well. Now that a lot of investors are very savvy and they like to do things online, on their own, there is, of course, the direct option of buying mutual funds. But in order to use the direct option of mutual funds, you have to go to each and every website of every mutual fund, manufacturer or product, supplier, which is the AMC. There's now another option, which is the MF Utilities website run by AMFI, which is the Association of Mutual Funds. Tell us what the difference is between the two, what the charges are different, and who manages these websites.
Mutual fund utility is a very interesting thing that has been sponsored by all mutual fund. In fact, it is configured as a separate company, and it is owned by all mutual fund companies. Most mutual fund companies have contributed to the capital of this. And the primary goal of mutual fund utility is to provide investors a seamless and unified access to all mutual fund. And mutual fund utility is not meant for direct only. In fact, it is meant for distributors, advisors, the mutual fund agents, because most investors buy multiple funds, and most mutual fund distributors, mutual fund agents sell funds of different companies. And for them, they have to, go to different registrars, interact with different people to get a unified view. Mutual fund utility makes it easy. If you open your mutual fund utility account, because what happens is you need to open your account once, and all your existing investment, all your old investment, you will get a unified view across the various fund companies, and you can also do subsequent transactions online, whether it be for your existing funds or your new investments. New investments, if you are taking this initiative yourself, you can well choose to invest through the direct plan. Even your distributor can enable can help you get started with mutual fund utility, and this is very beneficial to him because his need to provide service comes down substantially. And after you have opened your you need a CAN number, what is called a composite account number. After opening your account with mutual fund utility, all your existing investments are visible there. If you want to redeem any investment, if you want to make any new investment, you can choose the fund, get started. You can execute your STP, SWP, and you get you get all your investment visible at one place, which I think is a very special benefit. And it does not cost any money, because it is for the benefit of investors, and every mutual fund company provides for the expenses. Mutual fund utility is taken care of by the underlying investments, and investors don't have to bear any cost.
All right, so remember that the entire mutual fund utility account is based on your common account number, which is your CAN number, which everybody has when you begin investing in mutual funds. So, Dhirendra, do you recommend that all mutual fund investors, so all of our viewers, actually open an account right now on the mutual fund utility website in order to just, if not anything else, facilitate easier management?
Yes, I think anybody who is interested and anybody who wants to be on top of all his investments, want to have a close track of things, is inclined to be completely aware all the time and be self-guided. He should have a mutual fund utility account. It doesn't cost any money, and it makes life easier.
All right, it makes life easier. There is a mutual fund utility account that you can open. They recommend that we all open an account just to be able to manage our money better. And any incremental investments you're making, you can make through the direct route in one place. So up till now, what was happening, if you wanted to start a direct option fund, you had to go to the website of the EMC, you had to buy the fund, then connect it to your net banking. It was a long process, and you had to go to each website of each AMC. Now you're able to do all of it in one place. Then let's talk about our conservative portfolio. It has three funds in it: the FT India Dynamic P Ratio, the HDFC MIP, and the Reliance MIP. I understand you don't want to make any changes in this portfolio, but you were at one point a little unhappy with the performance of MIPs as a category in general. Do they still have your faith?
No, my complaint about MIPs remains. But I don't think there is any other way of building a portfolio which is which has little bit of fixed income, which has little bit of equity and remaining fixed income for the conservative investor. What we are targeting is 65-70%, nearly 2/3 into fixed income and remaining in equity, and I was trying to do it in a manner that requires least intervention. So from that standpoint, this portfolio is fine. Two MIPs also continues to be the best MIPs, or with higher equity allocation relative to others. So I don't think there's any problem with our portfolio. The real problem is my complaint about MIPs prevails. It's because it is dominantly a fixed income fund. It has small allocation to equity, and fund companies charge the expense that is levied on MIPs like that of a equity fund. So that is unfair. And I think particularly for an investor who is conservative, who is trying to get a little bit of equity exposure, largely wants a reasonably risk-free experience, or not a very volatile experience. For this investor, I think it's grossly unfair. So my complaint remains, except that the kind of allocation that we are targeting, this is the best way to achieve that.
All right, so a quick reminder to our viewers who are watching, this portfolio is meant for someone who's retired, who has already got a pension coming in for a regular income from one of your pension products, either your government pension or some other pension. You're looking at the rest of your investments, and you want to be able to beat inflation over the medium term. This is the portfolio that Dhirendra recommends for you. This portfolio has given us a return of over 10% over the last 7 years. If you have any questions about this portfolio, feel free to get in touch with us. Our email ID is at the bottom of your screen. Let's take a look at the financial plan we're analyzing this week. This week, a profile of a 40-year-old who has 2 dependents and who has a goal of his own retirement. NARASIMHAN has written in. He wants to build a corpus of 2 crore rupees for his retirement and 1 crore rupees to pay off his home loan. He plans to work in the software industry till he's 45 and then start his own consulting firm. He has sent us his financial details. He'd like to build a house at some point, and he assumes it will cost about 1 crore rupees in construction cost. He has 25 lakh rupees in PF, 15 lakh rupees in cash and investments and stock options that most IT employees do, valued at about 15 lakh rupees as of today. He also owns a 2-bedroom flat, which is valued about 45 lakh rupees, a monthly take-home of 2 lakh rupees. And he's invested in the Sukanya Samriddhi scheme for 2 years, which obviously tells us that he has a young daughter. I want to start with just that one point, the fact that he's written in saying that he has stock options. And I know that a lot of our friends in the IT sector receive stock options from their companies. And you're normally confused about how to deal with those options, because it involves parting some money in order to exercise the option as well. Was there any word of advice that you'd like to give people who are holding employee stock options?
His situation may not be that alarming because he has investments elsewhere. He has a land, he has a house, and he has other investments in mutual funds. But there are many people, many investors, there are many individuals who have their ESOP, and that is it. And so that is not a very desirable thing, because all those individuals are at great risk, because the time when you lose your job, it will also be the time when your ESOP will be worthless. And that is a very dangerous thing to do. So whenever you can actually, you think it is, you have encashable, the options when they get turned into shares after they're paid for, you should diversify. I think diversification is one thing which, the cardinal principle which everybody should follow.
Well, that's the tough part, really. If you're holding ESOPs and you don't have any of the other stocks, don't consider the entire ESOP portfolio as your stocks portfolio. You have to diversify in other companies as well. Dhirendra, these are the other investments he has. The Sukanya Samriddhi scheme, which he's invested in. He has 1 lakh rupees that he's invested in the gold sovereign bond funds. He has a term life insurance, employee health insurance, and some insurance separately that he's bought for his family. He'd like to save some money for his children's education, and he tells us that he's set aside some money conservatively for any sort of emergency that he has, and he sent us a list of mutual funds. He has the Birla Sun Life Advantage and Equity, the Franklin India smaller companies, the Mirae Asset Emerging Blue Chip, the iProve Value Discovery, and the Reliance Small Cap. He'll also be investing in the DSP BlackRock fund as well. He wants to know if his portfolio is on track. There's a lot going on in his portfolio. If we were to streamline it and make it sort of sharper, which way would you recommend he goes in now?
I would like him to really simplify his stuff, because he can do without that Sukanya Samriddhi Yojana, because this is like a 15-year recurring deposit for his daughter, and the triggers will be different. And he has already taken steps, which can't be reversed. But I think, for traditional reasons, for his daughter, maybe he is getting into that sovereign gold bonds. He should stop there. He has made he has bought worth 5 lakh rupees in the last 5 tranches. That's good enough. And this is a nice way to hold gold, just in case you're committed to having gold in your portfolio. But don't look at it as a portfolio. Think of it as, hedging against any big move in gold prices going up, and you will be able to convert it into gold, or you'll be riding the gold prices and earn 2.75% extra annually, which I think is a substantial thing. That apart, I think he should just work on his long-term portfolio and the emergency fund. Have a liberal emergency fund. Have a liberal thing to fall back. And keep your long-term portfolio, because most of your goal seems long-term. Building the house that's worth 1 crore, you will have enough money, but the investments will not grow enough if they're scattered and spread all over. And if they are dominantly into long-term fixed income, I don't think that's the right way to go. So and he has chosen good funds. Maybe he should try and combine his portfolio, bucket them for different goals, and have our growth portfolio and aggressive growth portfolio. And he already has all those funds in these 2 portfolios as part of his investment. He should make sure that he is not concentrated in 1 or 2 funds substantially, which looks like, because if you're investing 5,000 in one fund and another 25,000 rupees in the other fund, in course of time, one fund will be a very dominant part of your portfolio. Just have that spread, have this selection, bucket your investments for different goals, and just don't have more than 5-6 funds.
Don't have more than 5-6 funds in your portfolio. There is of the funds that he has right now, if you were to streamline his selection, would you say he should continue with the funds that he's holding, or will one of our portfolios suit him better?
I think, his portfolio can be mapped to our growth and the aggressive growth portfolio. So I would not like to suggest him big change, but he should look at one of our portfolio's weightages in different, because I have concerns about the amount of money going in different funds. Very little in some and too much in others.
All right, so that portfolio is on your screen right now. If you need anything else, you can get in touch with us. Premal has written in Dhirendra. He says he had a fixed deposit amounting to about 20 lakh rupees with Jayaprakash Associate Limited. Both the fixed deposits have matured on the 14th of March this year. But even after several letters and reminders, they've not been refunded the money with the maturity amount. He wants to know what he should do right now. What is the best way to recover his money? Is there any method that you would recommend?
She should complain with RBI, go to SEBI, and I don't think she should be very hopeful, because big banks are unable to recover their money from here. Over a period of time, there is some possibility, but this is, I think, a grim reminder to all the investors, all the people who fall for little higher return from a relatively shaky business. And mind you, this is a grim reminder that when you are making a deposit with a company, it is an unsecured loan to the company. It is not, you will have no coverage of the asset. So it's all in good faith, and things have turned bad for this company. And I'm not very hopeful that how soon, or if at all, you can recover your money.
Well, there's something very important here, Dhirendra, that the rest of us can learn from this one case. First of all, the money invested at this point is not a fixed deposit, but a corporate deposit, something that investors need to learn the difference in, which is when you give your money to a bank to keep in a fixed deposit is very different from when you lend your money to a corporate at a certain rate, which is normally slightly higher. Also, it's very important then to look at the rating that the corporate has received in terms of debt, which I'm not sure was the process that this investor has followed. Are there now some sort of guidelines you can give our viewers to use whenever they are maybe using a corporate deposit or deciding to invest in a corporate deposit?
No, my suggestion to investors will be that keep away from anything which is not AAA. And AAA for many decades except for those company deposits, you should never make a deposit, because most of these situations, most investors who have fallen for United deposits and GP, or even in the past, you have the Morpen Labs, which was taking deposits. High return on lower rating turns out to be giving your money away. So there are few companies in this country where who accept deposits. They have been accepting deposits. They don't give any substantial return over and above the deposit rates. They give marginally higher return. And they are the only thing worth going for. Rest of the money, if you will actually be falling for marginally higher return and losing your capital.
So remember very carefully when you're making these investments that they're not the same risk and return as a fixed deposit that you give to a bank. And if you want to make them, one of the best ways to do it, of course, is to buy a good debt fund instead of going directly into a corporate deposit. Key takeaways before we take a break: diversify your portfolio. Make sure that you not just have different asset classes, so debt and equity in your portfolio, but even within equity, that you have different fund houses and different funds or different stocks in your portfolio. Never make a corporate deposit unless they have a AAA rating for a fairly long period of time and you understand the risks of that corporate deposit, which are different from the risks and returns of a fixed deposit. Let's take a look at the Reliance Equity Opportunities Fund. Sumit has written to us, Dhirendra. He said he's been investing in this fund for the last 5 years, and he doesn't see returns in comparison to other funds of the same category. So he wants to know what he should do right now. Should he continue? Avan will quickly take us through the numbers, and then I want to go through your review of the fund to find out what our investors should be doing at this point.
Thanks, Faye. This week, we take a look at one of the mid-cap funds, the Reliance Equity Opportunities Fund. While the fund's long-term performance has been average, the fund's short-term performance has been disappointing. Let's take a closer look at the fund's performance in the last 5 years. The red line is the fund and the blue line is the benchmark. You'll see that the fund's performance has been average, barely outperforming its benchmark till the year 2014. In the year 2014, the fund performed relatively better than its benchmark with a return of 60%. On the other hand, the last 2 years have not been favorable for the fund. The fund was at its worst in the year 2015 with a return of less than 1%. The fund's one-year returns haven't been great either, with a return of just 6%. You'll also notice that with a 1-star rating on Value Research, the fund's peers have given much better returns over the long and short term. In fact, the fund was the worst performer among its peers in the last 1 year. Is it time then for you to pull your money out of this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Then the Reliance Equity Opportunities, like Sumit was telling us, there are investors who've been investing in this fund for a fairly long time. It's currently down to 1 star on Value Research, which is possibly also why it's causing investors so much concern. At 10,000 crore rupees, there are still a large number of investors who are still in this fund. What do you recommend they do?
No, this has turned from a very impressive fund to a very disappointing fund, and it has also tried to change track for in a manner which has caused this disappointment. This fund tilted towards the same kind of bets or positions or understanding. The kind of problem that we see with HDFC. It's bet on financial services, and most of the public sector bank, it took its own time to work out, or maybe it's still working out. Also, the fund has been a mid-cap fund for a while, and then now it's tilting towards large cap. Now it's about 50% in large cap and big companies, and it's classified differently right now because of its historic portfolio. So changing track, unable to get it right with its portfolio, very disappointing for the last 2 years, and I think there are better options across the board. If you're looking for a multi-cap fund, there are better options. If you're looking for a mid-cap fund, this is definitely not the fund to have. So this is a fund worth leaving aside now for now.
Right. It's a fund worth leaving aside right now. And for those investors who've been like Sumit, invested for the last 5 years, Dhirendra, is it time to pull their money out and reinvest that money somewhere else?
I think so, absolutely. It has slipped so much on the rating, risk-adjusted performance relative to others, and based on the kind of peers it should be compared with. So it has been consistently disappointing. It takes a great deal of effort to slip that substantially. And all this has happened very steadily over the last 4 years, and there might be a resurgence, but I think investors should not wait any further.
Right, investors should not wait any further. It's time to sell out of this fund and move your money elsewhere. Now, within that category, here are the recommendations on your screen right now. It's rare that we get a sell call on this show, but here is one. Dhirendra, finally, your star rating for this fund out of 5?
Such a clear sell, so it has to be a 1-star fund.
1 star then, a sell call for Reliance Equity Opportunities on Investors Guide. Let's move on to our segment called Buy a Home, where we help you make investments on the final goal of buying a home. Vishwanath has written in. He's a government employee and will retire in the next 4 years. He wants to build a home in his hometown worth 35 lakh rupees. He says he get a lump sum of 20 lakh rupees and a pension of 25 post-retirement. And he has health insurance that will look after him and his mother as an insurance cover, 15 lakh rupees. He sent us some mutual funds that he invests in. So if we consider his lump sum of 20 lakh rupees and the fact that his home is going to cost about 35, he's nearly halfway there. He has to basically fund the remaining amount. So he has the Birla Sun Life Dynamic Bond Fund, the Tata Balanced, the IPRO Balanced, and the HDFC Balanced Fund. Would you say in 4 years' time, these are the right funds to be using in order to reach that target?
No, I think these funds are not the suitable funds. I think you should look at our stable growth portfolio for this time frame. Even there, I would suggest that he should have a 4-5 years time frame, and so he can wait for a while post-retirement, not necessarily 4 years, because 4 years is while he's in job. But and he's unlikely to need all the money for construction on day one. He'll be needing it over the next 1 or 2 years. So that's a good enough thing to get started. You should look at our stable growth portfolio. Also, one important thing is that if he will get 20 lakh rupees and 10 lakh rupees his contribution in this portfolio, because 2.5 lakh rupees per annum, approximately 20,000 rupees a month, he should try and increase this contribution over the next 4 years in this balanced fund. Because his contribution will be barely 10 lakh rupees, and he'll be getting 20 lakh rupees lump sum, and he'll be left with no money post-construction. Also, mind you, I have that it's not a great fund. It's not my expertise. But just by watching my parents building their house, whatever you budget for, it always costs more. So one is that you are barely on the budget, and if it shoots, if you shoot the budget, then you'll hardly be left with any money. And if your pension is barely enough to support you financially for your day-to-day consumption, you will not be left with any financial assets for any emergency. So plan things conservatively, save as much as you can, and I think you needed more time and some more money to have that cushion.
Dhirendra, thank you so much for spending time with us this week and answering all of our questions. It's a wrap on Investors Guide. Remember, you can reach out to us with anything you need about your money. We're here to answer your questions. It will be our pleasure to hear from you. My contact details personally are on your screen as well. Get in touch. Thanks for watching.